Welcome, everybody. So, we're going to start our session number 7, and we are looking into how to manage a portfolio. We saw last time how to construct a portfolio. Now, we're going to look into how to manage a portfolio. And we'll start, of course, with investment management styles. You'll start with our usually short video. So, here it goes.
What if it's actually about finding a strategy that fits you, your personality, your life? Well, that's exactly what we're going to do today. We're going to break down the three main investment styles so you can figure out which one is your perfect fit. And let me tell you, getting it wrong has some serious consequences. I mean, this quote just nails it, doesn't it? It's not about finding the one best strategy out there. It's about finding the right one for your game. Because if your approach doesn't line up with who you are, you're not just going to have a bad time, you're basically playing the wrong game from the get-go. Okay, so to make this really concrete, let's think about two types of investors. First, you've got the pit bull. This person is always on the hunt, sniffing out deals, analyzing everything, and making moves pretty much weekly. Then, on the complete other side of the spectrum, you have the monk. Super patient, disciplined, just locks in to some simple index funds, and maybe checks in once a quarter. Now, here's the thing. Both of these people can be wildly successful, but their approaches are night and day. So, which one are you leaning towards? Let's dig in and find out. All right, first up, let's talk about path number one, the active approach. This is for all of you out there who want to be in the driver's seat with your hands firmly on the wheel of your portfolio. So, what's active management all about? Well, it really boils down to one core belief that you can beat the market average. It's all about taking control. You're the one picking the stocks, you're timing your entries and exits, and you're constantly making decisions to squeeze out that little bit of extra return. That's what a lot of pros call alpha. So, what's the day to day life of an active investor actually like? Well, for one, you have to genuinely enjoy the research. I'm talking about digging deep into company reports, following market trends, that kind of stuff. And naturally, that leads to trading more often, constantly tweaking your portfolio, and probably using a lot of charts and technical indicators. This is the Pitbull's playbook right here. Okay, let's totally switch gears now and look at our second path. If everything I just said about the active approach sounded, well, a little intense, then this next one might be right up your alley. The philosophy behind passive management is simple, but it's really powerful. Instead of trying to outsmart or beat the market, the goal is to just be the market. And look, there's a ton of data, decades of it, that shows just how incredibly hard it is to consistently beat the market, even for the pros. So the strategy here is to just capture the market's overall growth, what's called beta, by buying broad funds that track the whole market and just staying the course. And this right here is the core of our monk's mindset. A passive investor is all about two things: simplicity and low costs. Their behavior is the total opposite of an active trader. We're talking very few trades, holding on to things for years, if not decades, and purposefully ignoring all the day to day market drama to avoid making emotional mistakes. Honestly, patience is their superpower. But hey, what if you're listening to this and thinking, I'm not really a pit bull, but I'm not 100% a monk either? Well, that's where our third path comes in. It's the hybrid model, the middle ground. This is kind of the best of both worlds approach. It works on what's called a core satellite model. So think of it like this. The core of your portfolio is the big, stable foundation. That's your passive index funds. Then you have these smaller satellite positions where you can get a little more active, maybe place some bets on individual stocks or trends you're really excited about. So, what does that look like in practice? Well, usually a hybrid investor puts something like 60 to 80% of their money into that solid, passive core. The other 20 to 40%, that's their play money, so to speak, for those more active, tactical moves. It's a great structure because you get that stability, but you also get to scratch that itch to hunt for some unique opportunities. Okay, so we've laid out the three big paths: active, passive, and hybrid. Now comes the most important part of all: figuring out which one is actually yours. And this is all going to come down to being really honest with yourself. So let's go through some key questions you need to ask. First question, and it's a big one: time. And I mean, let's be totally realistic. Not how much time you wish you had, but how much can you actually set aside each week? Are we talking a couple of hours a day, or is it more like a couple of hours a quarter? Your answer here is a huge piece of the puzzle. Next up, how does all this market stuff make you feel? Does following the news and looking at charts get you excited, or does it just give you a ton of anxiety? Because an active approach really requires you to enjoy it. Otherwise, it's just going to feel like a miserable chore, or even worse, a constant source of stress. All right, let's talk about risk tolerance. It is super easy to feel like a genius when the market's going up, right? But what about when it's not? How would you really feel if you looked at your account and saw it was down 20%? Your honest gut reaction to that idea is so important because it determines if you'll actually stick with your plan when things get scary. And what's the whole point of this for you anyway? What are your long term goals? Are you trying to grow your money as fast as possible? Are you looking for a steady stream of income? Or are you just trying to protect what you already have? Your end goal is going to have a huge impact on which style makes the most sense. And finally, let's just boil it down to this. How hands on do you really want to be? Are you someone who wants to be checking in and making decisions every month? Or are you more of a set it and forget it type who's happy to check in once a year? Your answer here should point you almost directly to one of these three paths. Okay, so once you have a good idea of which path is for you, the next logical question is, how do you actually put your money to work? Because, how you deploy your capital can be just as important as what you're investing in. When it comes to actually getting your money into the market, there are really three main ways to go about it. First, you can just go all in at once. That's a lump sum. Second, you can dip your toes in over time, which we'll call incremental steps. Or third, you can have a more structured plan for buying and selling over time, which is known as planned drawdowns. It gives you a bit more flexibility. And here's the cool part. You can see how these methods line up almost perfectly with the styles we've been talking about. For the passive investor, who's all about the long game, a simple lump sum often makes the most sense. The active investor, they're more likely to use incremental steps so they can react to what the market is doing. And that hybrid investor, well, they might use planned drawdowns to manage that core and satellite portfolio really strategically. So when all is said and done, I really want you to take this one thing away. Market ups and downs, they're going to happen. That's not the biggest risk you face. Your greatest risk isn't the market's volatility. It's mismatching your investment style with your actual reality. It's picking a strategy that fights against your personality, your free time, and your goals. The real key to success is to know yourself, pick the path that fits, and build a plan that works for your life.
Okay, let's go back to our presentation and let's look at it a little bit deeper into this question of matching an investor style with his personal characteristics. And let me start with showing you first the questions that you need to choose and what is the impact that they have in your management style. Okay, first of all, do you want to be an active manager, or do you want to be a passive manager, or do you want to be an hybrid? Of course, SADI platform is built mostly for hybrid type of investors. It means that we take a long perspective. We seek to have as low turnover as possible, but we search to do it in a way that we can improve our performance, both through the strategy that we use for deploying the capital, and also how each individual should tailor his own situation to the tools that we have in the platform. Let's begin with the question of active, or rather the question of how an hybrid investor can or should use our platform. The first thing he needs to know a little bit is about his own personality and his attitude towards risk. And for that we have an interesting questionnaire in our platform in the planner section, and I advise you to do that questionnaire, which helps you to see how much you are of a maximizer guy or a satisficer guy, or how much you are affected by drawdowns in the market, your regret profile and so on, because these uh, personal characteristics are important to select your style and the kind of portfolio that you need to run. So it's we all think that we know ourselves very well, but very often we don't know really how we are. And unless we have already quite some experience of investing, where we already learn our um, uh, advantage and our disadvantage, we have some difficulty into look into that. So this questionnaire that I suggest that you do, you can do it online as well, can help you to give you some idea about what kind of personality you have and how it might affect your investment style. Because as we saw in the presentation, matching our profile is very important. And the profile can be in terms of, a special how you like or don't like staying in front of the computer and looking at your portfolio. By the way, one of the purpose of our platform is actually to minimize that. You don't need to stay sitting in front of your computer every day, maybe even not every week. Some people just look at their portfolio once a month. Some look at the portfolio 3 times a month. Some people like to check the position of their portfolio every day, so it's no problem. But you should not stay in front of your computer every day and trying to figure out everything. But it also requires that you do a little bit of research. So if you are, say, completely against doing any research, you probably would be better by following a passive investing uh, strategy and choosing a few ETFs to do that. So, okay, an hybrid investor, which can use both passive and active strategies, needs to have a little bit of interest in the markets, but doesn't need to be a guy who is glued to the screen to watch the markets evolving. So that's the essence of our approach. And of course, you also need to know what is your risk profile. How much you can cope with risk, and especially what kind of losses you can incur without losing your sleep. So that's very, very important to do that, and also how quick or fast you are to react to the market events. So the kind of guy who draws his pistol immediately, or the kind of guy who first tries to look where is his target. So you need to know what kind of personality you have in terms of a reaction to events in the market, which we all have events every every week, or every month, or at least every year. There's always events that will catch your attention, and you need to know what kind of reaction you need to do. Also, you need to take into account whether you are the kind of guy who does a lot of analysis, or does a lot of research and so on, but then becomes paralyzed by the research because he did so much. He looked at so many aspects of a problem that then he doesn't know what he should do, because he gets confused with so many options and so on. So you also need to know if you are that kind of guy or not, or if the guy that you are satisfied once you saw a few perspectives about your portfolio, and then you act accordingly without spending procrastinating, waiting to decide what you should do. So again, there is nothing. People sometimes think, okay, the guy who needs to be a good investor has to be this or that characteristic. He doesn't need. I mean, people are completely different. So it's important is that someone realize what are their characteristics and how they impact on his investment style, and then match his investment style to his characteristics, and do not try to imitate the guy who has succeeded by being very fast at moving into the market, or the guy who was very found some unique perspectives on the market and so on. So everyone can benefit the market as long as he managed to tailor his investment style to his own characteristics. Okay, so that's the first thing that we should be aware of that. And now let's look a little bit more in detail into the question of how we should deploy the capital. Again, deploying our capital also has a few characteristics that need to be taken into account. Let me see if I have. Okay, you have here also, you know, some. You have a mirror, so that you can look at the mirror and see, you know, what, how, who am I, and then allocate your, make your investment style based on that. It wasn't this slide I wanted to show you. It was another one about the capital deployment. Okay, which should be here. And I don't know if there's one before this or okay. So we can look at this slide. So of course, depending on what, as I said to you, it's very important how much money you have to invest. If the money is yours, or if the money is from somebody else, you are acting on working for somebody else. Well, these are key issues that we addressed last time. But again, you need to know how you should deploy your capital. So if you have an inheritance and you have a large lump sum of money that you want to invest, then you can invest it immediately at the start of your portfolio construction. And there is a way of investing. The other way of investing, which is very common to almost everybody, is to invest on a regular basis. So you save a certain amount of money every month, and then you decide to put it into the market, and you do it on an incremental basis. You're going to invest periodically every month or every quarter or every week, whatever your periodicity is. And likewise, if you have invested a certain amount of money, be it on incremental basis or a lump sum, you may wish to plan your drawdown. So how much money you will withdraw from the market, and this is also a very interesting way of looking at things. But let me say again, this depends on your personal circumstances. So you know it's, but we'll advocate here a way of doing it, bearing in mind that take into account that you can actually mix all these ways of investing, of deploying your capital in the same strategy. Let me show you here a slide which I think has something like that. No, it's not here, but anyway, I'll show you probably. I'll show you in the platform. That's probably best. And this method of let me see if I can find here an allocation. Okay, I have here one. Okay, so what we have here in this allocation table is that an investor can invest 24 by 20. Imagine that the amount of money that this person had would justify buying 24 stocks in a single country. And in this case, let's say in Germany, which is it's just an example, doesn't matter. And he would plan to invest throughout 2 years from 26 to 28. So if he wants to invest and to buy initially 24 stocks, you see, he actually may consider that his portfolio is made up of 24 stocks, but it's going to look in a different, take a different perspective on how he does this investment. So let's imagine that he assumes that out of the 24 stocks, 2 stocks will be held from the initial date until the end of the investment period. It will be a buy and hold strategy. So it's invested in this in the initial period, and you will continue investing that in the same. Then he thinks that two of those 24 stocks will turn red. It will be rated as a sell stock in their portfolio. So they will sell these two stocks and buy two new stocks. You see, again, he keeps the 24 stocks. Again, the same thing. If he is going to change two stocks he's going to change to invest two new stocks again in the three is this quarter, I think, yeah, in 3 quarters time he's going to invest another two, which he sold because he's basically what he did. He assumed that every quarter he will have two stocks that underperform, but he wants to keep all the same number of stocks in his portfolio. So he sells some stocks, but he keeps the money and buy others. So in this way, he's rotating his portfolio, as you can see, but he always keeps investing 24. So let's imagine that this investor started with investing his money in a lump sum way, but then he evolved to, in fact, carry out an incremental investing by, rebalancing his portfolio, changing his portfolio accordingly. So, and he used to like that, which means that he would be withdrawing. So basically, you can, even if you start with a lump sum, you can actually implement the other two strategies. And in fact, it's a bit like this that a lot of insurance companies work when they invest your premiums. They invest them straight away, but then they will keep investing them on an incremental basis and then withdrawing them also on an incremental basis to pay your indemnities and so on. And so there is nothing wrong with actually planning your investment as a lump sum, but then managing the portfolio as if it was a portfolio that includes the three strategies. So this approach is an approach that we may call a staggered investment approach, which means that we're going to invest this on a regular basis. And this invest also on a regular basis, so that means that we can start with a lump sum of money and do it like this. So this is another possibility. So what you can do in a table like this, you can create your own table like this, is actually have the total amount of stocks that you want, in this case 24, and then how you foresee that your stocks will be underperforming and that you need to replace them, which gives you, so I have put here two stocks, but that's just an example. So some cases you may have 3 stocks, you may have 1, and but the whole thing is that by investing in this staggered way, you always keep renewing your portfolio, but not too frequently. You see, so in the end, you don't have a very high rotation. It's different for me. Let's say that you started with the 24 stocks in the first month, and then you decide to sell all of them after the first quarter, and then sell them again, all of them in the third quarter, and so on. So that would be a very almost an extremely active type of investing, which we don't recommend at all, because you wouldn't let your stocks appreciate enough, and you would incur a lot of trading costs, and you will suffer a lot of regret in some of them that you sold prematurely, or some that took you too long to you didn't wait for them to appreciate, and so on. The whole thing is as well is that you can. I have also put here a mixed strategy. But as a matter of fact, you can actually change to make changes here and select different strategies. So if you are keen on some of these strategies rather than using a mixed strategy, you can start with a mixed strategy in your lump sum money, but then you can reinvest. When you reinvest those that you can use different strategies. If you think that combining or if you realize that a given strategy has been underperforming in the recent period, then of course we're going to do a very simple thing, which is changing your strategy. But by the way, don't change it too much, because if you change this too much, then your whole portfolio during the whole period that you are invested in this amount of money is going to much mixed up, and maybe don't take advantage that some strategies may require a bit more time that others to materialize. For instance, let's say if you choose a value strategy, it might take a long time to materialize, and much longer than for instance, if you chose a growth strategy. But this is another important aspect about deploying about how do you deploy your money. So again, let me recall, deployment is one of a very important, it's something that most people neglect. They say, okay, I have here 1 million, I'm going to put in stocks and that's it. And then keep changing it and so on. But never think about the way they are going to deploy their money. And that is a bit of a problem, because they are still going to move around in all directions and trying to catch a moving target, and they never catch the target. So to recapitulate then, investment style is about choosing strategies that meet your personal characteristics, and then choosing a deployment way of allocating your capital throughout the investment period, throughout your investment horizon. And let me alert you for this, is that very often you see people talking about investment styles in relation to choosing a strategy. Let's say I'm going to choose a momentum, a dividend strategy, whatever, ownership, and they refer to this as styles of investment. This is is a bit different. So a style of investment is actually alignment of your profile with your strategies, and choosing strategies in a consistent way with the way you plan to deploy your money. So that's basically our definition of investment style. Is not just say that, okay, I'm a value investor, this guy is a growth investor. Okay, we have different investment styles. No, we follow different strategies, that's fine. The investment style is something different, okay? All right, so we finished our first part here.